A Roth conversion can be a smart move for a lot of retirees, but here's the problem. Time and time again, I see retirees make common but avoidable mistakes. These mistakes can cause them to underconvert, accidentally trigger thousands in extra taxes, and trigger higher Medicare penalties. In this video, I'll give you 5 simple checks to run before you convert this year so you don't get blindsided. The first problem I see from too many retirees is not understanding something called capital gain stacking. And this misunderstanding often leads to missing out on key conversion room, which means people underconvert and leave opportunity on the table. Let me show you what I mean. On the screen, I've got the 2025 tax brackets. Most of us understand these at a high level. If you're trying to fill up the 22% tax bracket as a single filer, you think, I just need to get my taxable income up to $103,350. Seems simple, right? Well, let's walk through an example for how this works out. Here's this retiree situation. They have a $12,000 pension, $22,000 in capital gains, $15,000 in dividends, and $18,000 in IRA distributions. Okay. Now this retiree has the goal to fill up the 22% bracket, and I included a little snippet down below to show where those brackets end up for single filers. Now, the current taxable income is $51,250. Given this, how much Roth conversion room does this retiree have? Now, humor me, pause the video for a second, and try to work out this math yourself. Here's what I find most retirees do when working out this math. We take the top of the 22% bracket, subtract out the current taxable income, and we get a value of $52,100. So that's pretty simple. That ends up being our total Roth conversion room, right? But that's actually wrong. Here's why. Ordinary income and capital gains are two different tax systems that interact in tricky ways. Capital gains don't sit inside of ordinary brackets, they stack on top. I've laid out a more visual way to look at this on the screen. Before the Roth conversion, ordinary income fills up part of the 12% bracket, and then capital gains layer on top of that, with some taxed at 0% and some spilling into the 15% bracket. So if we're actually trying to fill up the 22% bracket with ordinary income, the real conversion room here is about $87,000, not $52,000. And notice, whether you convert $52,000 or $87,000, you are already pushing those capital gains up into that 15% zone. So stopping at only a $52,000 conversion leaves valuable space unused. That's the mistake I see all the time. People calculate off taxable income without paying attention to the composition of ordinary income versus capital gains. And it causes them to underconvert relative to the target that they had in mind. The second spot check is Medicare's IRMAA, one of the trickiest tax traps in retirement planning. IRMAA sets income thresholds where if you go $1 over, your Part B and Part D premiums jump, sometimes by thousands of dollars a year. It's tricky for a few reasons. First, it's based on a 2-year look back. So at age 63, you need to start planning for IRMAA because your income then determines what you'll pay when you hop on Medicare at 65. Second, IRMAA doesn't use taxable incomes. It's based off modified adjusted gross income, which adds back things like tax-exempt interest. This means the numbers on your tax return don't always line up with the numbers Medicare is looking at. Let's walk through an example here. This retiree is 64 with taxable income of about $60,000. I also have a table showing 2025 Medicare premiums based on IRMAA. Now you'll see how this 2-year look back creates a trickier landscape than it first appears. 2025 Medicare IRMAA tables are based on 2023 income, which means 2025 income will determine 2027 premiums. Okay, well then why aren't we showing the 2027 IRMAA tables? Well, they haven't been released yet. To solve for this, we need to use a conservative inflation rate to make an educated guess at where 2027 tables will be. This is a table we look at for all of our clients in that IRMAA age range. As we look at the 2027 brackets, we are assuming 2.5% inflation, which you see will lift the IRMAA levels from the current 2025 thresholds. Now remember, IRMAA doesn't look at taxable income. It looks at modified adjusted gross income, which is $76,000 in this case. So this is the number we care about. Now remember, this retiree's goal was to max out the 22% bracket. But does this goal actually make sense, or should they modify their target? Well, let's look at their situation in a more visual way. Here's their tax graph, annualized for this year, assuming we don't do any Roth conversion. If this retiree wanted to do a Roth conversion and make sure they avoided all IRMAA penalties, they would only have about $35,000 of Roth conversion room here. Notice how this would leave them way short of maxing out the 22% bracket. If instead they just ignored IRMAA and maxed out that 22% bracket, they would be subject to 2 IRMAA penalties because they crossed over threshold zones. Remember that IRMAA is a tax cliff. It doesn't matter if we go $1 over a threshold or $10,000 over, you are subject to the full penalties. So you'll notice the second IRMAA threshold zone falls about 10,000 short of the 22% bracket. It almost certainly doesn't make sense for this retiree to take an extra $1,000 plus IRMAA penalty for the ability to convert around $10,000 more. They'd be paying a 22% tax rate plus another $1,000 in Medicare costs. So an over 30% marginal tax rate on that last $10,000 they converted. And so the second spot check here is to make sure you are acutely aware of where you are in relation to these IRMAA penalties. When Roth converting over the age of 63, we rarely look at max the bracket strategies and instead look at max IRMAA band strategies, because just like this situation, following the brackets can lead you to some costly zones. The next spot check we'll discuss is the phase out of tax credits and deductions, another area that commonly trips up taxpayers. Now, there are a number of tax credits and deductions one has to consider in tax planning, but we're going to just walk through a specific example and then show a list of other phase outs that you may want to consider when you're performing Roth conversions. We're going to look at a situation for an early retiree, a couple who is 55 and currently has 2 children in college. Being an early retiree, this couple is living heavily off their taxable account, and so only has capital gains, dividends, and interest that make up their current taxable income. Being that they help their children with paying for college in some minor ways, they are eligible for something called the American Opportunity Tax Credit. This credit offers them up to $2,500 in total tax credits for each child. Remember that a tax credit lowers your tax liability dollar for dollar. Also, this couple is on ACA insurance but have reported a high income because they expect to do somewhat large Roth conversions. Now, here's the problem this couple faces, likely unknowingly. This American Opportunity Tax Credit phases out at certain income levels for both single and married filers. So they might initially have the goal to do some Roth conversions and max out the 22 and 24% tax brackets, but doing so will mean they lose out on that $5,000 tax credit. Let's look at the cost of phasing out these credits in a more visual way. Here's their tax graph showing the marginal tax rate they pay at each step of income. Now, a portion of this tax credit, $1,000 per individual, is technically a refundable portion, and $1,500 is non-refundable. Now, this tax graph might look confusing to some, but rather than getting into all the intricacies of this graph, let's just look at it high level. What we see is this American Opportunity Tax Credit transforms their tax graph in a way most people don't readily understand. In green and yellow, we see the effect of bringing our income up too high. For over $20,000 worth of that Roth conversion, we are paying marginal tax rates of nearly 50% and sometimes even higher. This will make that Roth conversion quite a bit more costly than this couple was first realizing. Further, remember that I said this couple was on ACA but reported a high income because they thought they'd be doing some large Roth conversions. Well, this tax credit phase out might cause them to rethink that idea because they want to earn this valuable credit while their children are still in college and they're contributing to their children's college. Okay, well, that probably leads us to a question. Might it actually make sense to keep our income lower then and earn large healthcare subsidies? Technically speaking, the subsidies that you earn on ACA insurance are a refundable tax credit, and this too has phase-outs. Let's layer the subsidy phase-out tax rates into this tax graph, and they'll be shown here in purple. As you can see, this added step obviously adds complexity, but completely changes their tax graph again. Given this, it will likely completely change their Roth conversion strategy as well. This is why making sure you look at your full tax picture is so important. Most people just simply dummy down Roth conversions to simple max the bracket techniques, and by doing so, many retirees don't realize the effects of their Roth conversions in the background of their tax picture. Here's a snapshot of the different tax credits and deduction phase-outs you may want to look at as part of this process. Now, a number of these likely won't apply to your situation, but the ones that do are important to spot check against. Now, a quick aside before we move to the final 2 spot checks. Since joining Merit, our team has been able to expand capacities and lower our minimums for viewers of this channel. If you're interested in exploring working with us, use the link or phone number in the description below and mention that you've been watching our YouTube channel. If you call Merit's mainline or fill out a more general form, you might be paired with a different advisor who may not share our exact planning philosophy or may charge higher fees. Using the link below ensures you connect directly to our team. Now on to spot check number 4, factoring in weird state tax phase-outs. The only reason I call them weird is because each state has its own set of rules, often different from federal rules, that can create some surprising spikes in taxes. Let's give you an example. Here we are looking at a retired couple in Utah. Now Utah's state tax rate is 4.5%, but a fair number of states will have certain exclusions built into their tax laws that allow retirees to have tax-free retirement income or tax-free Social Security benefits, but only generally up to a certain point. Then the tax-free status phases out. This is exactly what we see in Utah. Utah offers a tax credit for retirees, but this credit phases out at certain income levels. The problem is these phase-outs create different tax spikes on the graph that more than double and sometimes almost triple the posted flat tax rate of 4.5%. This matters both for Roth conversions this year, but also forward tax planning into the future. You don't want to convert willy-nilly into these zones without understanding the impact and making sure conversions make sense at that given tax rate. A state like Minnesota has similar phase-outs around Social Security. Minnesota allows you to exclude federally taxed Social Security benefits from its state taxation. However, they recently implemented a phase-out of the exclusion where above a certain income level, the exclusion phases out by 10% for every $4,000 of income. Because of this, you will see 10 spikes on Minnesota's retirees tax graph that you may want to plan around carefully. These spikes can raise your marginal tax rate quite significantly. Now, with all of these spot checks, I'm not making a statement as to whether you should or shouldn't Roth convert into these zones, but you need to be aware of them so you can make the active decision. Yes, I know the marginal tax rate is spiking. This Roth conversion still makes sense, or it doesn't make sense and I should perform a more conservative Roth conversion. The devil here is in the details when it comes to tax planning. Then the last spot check is once again dealing with capital gains. I'm going to discuss two commonly ignored issues that come up with capital gains, something called capital gain bump zones, and then something called the net investment income tax, or NIIT. Let's talk about net investment income tax first. This is often forgotten about because if you pull up the 2025 capital gain brackets, you will generally see three capital gain tax rates, 0%, 15%, and 20%. There are actually four capital gain brackets that are created when we factor in net investment income tax. This is an added 3.8% tax on interest and capital gains once you cross a certain income threshold. That threshold is $200,000 for single filers and $250,000 for married. These levels are not indexed to inflation. Now, to expand on net investment income tax and talk about other capital gain issues, let's revisit an example from our first spot check. Let's talk about this idea of a capital gain bump zone. What is a bump zone? Well, remember that capital gains stack on top of ordinary income. So before this person performed a Roth conversion, they had most of their capital gains taxed at 0% with a small portion taxed at 15%. With performing any Roth conversion, they're going to force a double taxation within their situation. They are paying a 12% tax rate on any conversion they initially do, but the extraordinary income is forcing their capital gains from being taxed at 0% to now being taxed at 15%. So every dollar of a Roth conversion is going to initially be taxed at 27% when we combine those two rates. This is referred to as the bump zone because you are bumping up capital gains into being taxed at higher rates. Now, if we look at the tax code, there are three bump zones, but more commonly, retirees will often only have to worry about the first two because the last one is at some pretty high income levels. The first bump zone is the biggest. The second, when we factor in NIIT, is a bit more minor. Let's look at this in the context of a tax graph. In red, you will see the first bump zone, and in brown, you'll see the second. The length of the bump zone directly corresponds with the total dollars that you have in interest, dividends, and capital gains. This can create a pretty tricky tax spike for many retirees. We talk a lot on this channel about using a taxable account early in retirement to create extra room for Roth conversions and empty out that leaky bucket. However, using your taxable account generally means realizing more in capital gains and therefore creating a bigger bump zone. Now, there is a lot a retiree can do to minimize these bump zones by strategically selling certain assets, using carry forward losses, and using asset location wisely. But in many cases, it also creates big enough tax spikes on your tax graph where it may control how big of a Roth conversion you do as well. For instance, let's say this couple was comfortable converting at a 22% tax rate, but not at a 24% tax rate. This couple would not want to max out the 22% bracket because they are pushing themselves into that net investment income tax zone where their marginal rate is actually 25.8%. They may even need to consider if it's worth going into that first bump zone as well. As you can see, the marginal rate there at 27%, or if they have enough room to spread out that higher tax spike. Again, the most important thing here is to have a clear map of your tax picture, as we've shown in various spot checks up to this point. Too many people use back of the envelope calculations to decide their Roth conversion, and by doing so, unknowingly pay a lot more in taxes than they need to, and even ruin the value of their conversion. Make sure you have the data and are planning strategically. Now, these aren't flashy parts of retirement planning, but they're exactly where thousands of dollars can slip through the cracks if you're not careful. And that's why I always say it's not about having more money, it's about having a better plan. If you found this video valuable, make sure you hit the subscribe button down below so you don't miss future videos on retirement tax strategies and planning. If you want to explore working directly with our team, use the link in the description to connect with us. Thanks for watching, and we look forward to seeing you in the next video.